20% is a really meaningful allocation within an overall asset allocation. That's a big chunk. It's not the majority, but it has the ability to really impact return.
Alternatives. It's a topic that has become much more talked about over the last decade or so. And I have the privilege of discussing alternative investments with Don Drury. Don is the president of Moran Wealth Management. Don, thanks for coming on the show.
Hey, thanks for having me.
Awesome. So what we like to do is break down the topics. As I mentioned to you before, this show is really geared towards folks who have achieved a certain level of financial success. They've done all the blocking and tackling, and now they're facing retirement in the next 10 to 20 years, and they're thinking to themselves, how can I ensure that what I've done thus far will achieve or meet the goals I have for retirement? And alternatives is a great topic to discuss, right? So let's just understand the basics. Let's break it down. What is alternatives in contrast to stocks and bonds?
That's a big subject. So stocks, bonds are all publicly traded securities. So I think we all know that we can go on our favorite app, call our broker, speak with whomever you're working with, and you can place a trade for Amazon or buy a bond. And those are publicly traded securities accessible to anybody who has the money to invest in it. Alternatives historically have been this ethereal, special thing.
Sure.
That was reserved for the wealthiest of wealthy individuals. It has become, over the last decade or so, democratized, where regular folks like us have the ability to access these alternative investments. So what are they? Well, if you think about it, there are 58,000 publicly traded securities globally. So that's anything you could go on your favorite app and buy. But in America alone, there are 33 million private entities that could be invested in. So it's the ability to invest in the broadest part of the economy. I think you and I have talked about this, that your kids love Shark Tank.
Yep.
And I remember my kids love Shark Tank. And I think we all like the idea of that. Oh, that's pretty cool. I'd love to invest in X or Y. Private equity is very similar to that. You're able to buy these fledgling companies, some far more mature than others. I mean, you can look at companies like SpaceX that we all hear about. That's still a private entity, even though it is a ridiculously large entity. But it gives you the ability to invest in a much broader array of securities. And those securities can replicate equity, can replicate fixed income, can replicate real estate, commodities. Earlier today, we were talking about crypto. It could be crypto, something of that nature. I think it comes down to a lot of people thinking, well, why would I do that? Why wouldn't I just buy Amazon or Apple or Nvidia, whatever, on public markets? The reason you would want to potentially consider it, you have the ability to earn outsized returns. And those outsized returns are given most often because of the lack of liquidity. You have to get a premium. You have to be paid a premium for that lack of liquidity. Doesn't guarantee it. Obviously, alternative investments, just like public investments, there are no guarantees. But you have to look at a broad section of data, and historically, they have achieved higher returns. Private equity, alternatives as part of a meal. And you look at your allocation, your stocks, your bonds, your cash, and those traditional things that we all, our 401ks, the things that we do. I look at that as kind of the meat and potatoes, the protein and the starch of your meal. And I think about alternatives as those side dishes, as the spice, and really sometimes as the additional nutrients for that meal. You want to be very careful as you enter that because there are lockups, there are periods of time where you don't have access to your funds. Sometimes the transparency or the ability to see inside isn't as great as it is owning a famous company. But there's a ton of reward that comes with that.
And that's why high net worth investors have flocked more to alternatives as of late. We're seeing obviously you mentioned democratizing, which is awesome, right? But we're seeing more and more focus, even from the high net worth group, on alternatives. Is that the reason why?
The reason why is for high net worth and ultra high net worth individuals and institutions as well. Think about endowments and all those big institutions. They invest in them because they receive higher and outsized returns. Secondarily, they invest in them because of correlation. So correlation is, how do two things react together? Are they independent of one another? Do they move in tandem? When we build portfolios and when we're trying to find that nice, stable ride that we all want, you try to put together assets that are lowly correlated so that they're not all going up together or all going down together. Now, truth be told, when the markets really get rough and you have these big black swan events, things that shouldn't be correlated usually become highly correlated and they go up and down together. But if you think about public markets, stocks, so much of what's built in when you're watching CNBC or Fox Business, it's based on what people think about in the macro economy. What's going on with the trade tariff? What's going on in the Middle East? All of these potentially exogenous events are being factored into the price, which really have very little to do with whether or not Johnson & Johnson is going to sell more Band-Aids, right? I mean, really. There's some inelastic demand for that. The beautiful thing behind alternative investments, they're traditionally priced on fundamentals. It takes out a lot of the noise that really creates volatility in the market, and they get priced in a more transparent manner. What many people like and what I like about it is creates more stability. Investor psychology. We all know that we have a tendency to make poor decisions when the markets are high or the markets are low. The markets are low. Tariffs, Trump announced tariffs. Oh no, it's the end of the world. And I should raise some cash. Having the ability to go sell my Tesla, my Apple, my JP Morgan, I can do it in a second. But with my alternative investments, my private equity, I can't. And it helps protect me from my own bad decisions.
So you're saying that's actually a benefit, the illiquid nature of alternatives.
Well, it can be a pro and it can be a con.
Sure.
But I will say from an investor psychology standpoint, I think it's a pro. I know that I've done this for 30 plus years. I know that my gut, when things are bad, I'm like, oh, that's not good. But I also know that there hasn't been a period of time where we've had economic problems or woes. Look at 2000, look at 08, look at COVID. We've always marched on to higher highs. But yet often we make a decision thinking that there's going to be this straight line down that hasn't happened.
Sure. That's interesting. I like that because you mentioned a lot of the benefits, right?
Sure.
The diversification, if you will. I didn't really think that the illiquid nature is a benefit. And when you think about it, it is. Now, and you mentioned some of the risks, but let's just go over some of those risks in more detail. What are the risks involved with alternatives as a whole? When you think about, I mean, obviously the illiquid nature is
Right.
one of them, but what other risks would an investor need to consider before entering into the alternative space?
Well, there could be a risk of liquidity. Perhaps you didn't spend enough time planning and think through what are you going to need for liquidity. Perfect example. I think you're planning a move sometime soon.
Yeah, I sure am.
I think you have a boatload of children that
I sure do.
that need to go to school, that
Uh-huh.
are going to have private education, that are going to need college. You need a lot of liquidity.
And you know what's really funny, Don? I don't know if I actually admitted this to you, but because I have some alternative investments in some software companies, I'm looking at those. I'm looking at those right now, saying, "Boy, it'd be really nice if I could access that capital," and I can't.
So that can be a potential downfall. And that's one of the things that we really try to work with clients on is first make sure that you have the right allocation to equities, fixed income, whatever that may look like for that person based on their risk, reward, those types of objectives.
Sure.
But then we all need to have a certain pool of liquidity. What if someone loses a job? What if there's an opportunity to buy X or Y? There are just so many other things. Once you have that, then you begin to allocate into this. But once you're in, certain types of investments don't have liquidity, but there are others within the alternative space where you have potentially quarterly liquidity and can access funds. So if you have plenty of liquidity, you don't need those types of alts. If you don't have a lot of liquidity, that would be the first area that you might, one of the components that would be important.
Sure. So before we move on to, because I want to just talk a little bit more about each category. We don't need to go through all of them, obviously.
Sure.
But let's just talk about the top 4 or 5. But before we do that, I remember when I made my first alternative investment, I stumbled upon the accredited investor kind of category, and I was actually kind of struck by this, right? And at first I was like, why are there regulations around what I do with my money? And so I don't want you to defend the case whether or not that's a good thing, but can you tell us more about what it means to be an accredited investor?
I can. So an accredited investor is a hurdle that's established to make sure that people that get positioned within alternative investments potentially have enough income, enough liquidity, and potentially enough sophistication to properly make that decision and it be the right thing. So what is that test? That test is $200,000 of income for an individual with the likelihood that that will continue, or $300,000 for a couple, same likelihood that that will continue, or last one, $1 million of net worth, excluding the equity you have in your home. So that's kind of the hurdle to have access as an accredited investor.
And I think we're going to see a change there, and I don't want to speculate, but we're seeing a lot more kind of enthusiasm around VC, angel investing, trying to get smaller dollars into some of these things. We're seeing
Yes.
like, there's those websites now where you can kind of like raise funds that way.
Crowdfunding?
Yeah, exactly.
Sure.
So we're seeing a little bit more of that shift. What's interesting though is, do we continue to prohibit those who want to make those alternative investments? I don't know. I guess I don't know the answer to that.
Right now, you're hearing about legislation that potentially would allow those types of investments to be made within 401ks, which would really open it up and give the ability for a lot of investors to have some access to this, which is great. You and I are both whiskey fans, right?
Correct.
I am pretty sure, and I can't remember the name of it, but there's a company that allows you to invest
Yes.
in barrels of whiskey that potentially have the ability to appreciate over time. I know that there's one that does art, and these are available to the masses, and you can You get targeted for this. And I'm not saying whether it's good, whether it's bad. I think when someone's looking at building out alternative investment portfolio, those shouldn't be the first things you're looking at. Those are the esoteric. Think about the food pyramid. Those are the things at the top of the pyramid that are the last pieces you add that maybe fall within an interest you have, potentially could earn outsized returns or negative returns. I think you're right. There's a lot out there. I think measuring twice and cutting once is important, particularly as you build an alternative portfolio. You really want to make sure you understand what it is, the fees, whether it has a 1099 or a K1. You may be receiving different tax documents. You may need to file later. There's a lot to it, but there's a reason why the potential is there to have some outsized returns.
Got it. Very helpful. I guess I'll just wrap with this final question. When someone, like just a typical investor, is considering alternatives, and I know this is a loaded question too, but there's no one better to ask this than you, Don.
Great.
How do we think about weighting or sizing when you look at your entire portfolio?
Sure.
Alternatives versus traditional stocks, bonds, equities?
Well, I'd love to give you an answer that's applicable to everybody. I'm not trying to hedge here, but it depends on the individual. Perfect example. We were talking about you earlier. You've got a lot of current and future needs for liquidity, for capital. You probably should have less in alternatives than I should. I'm a little older. My kids are older. My need for liquidity is far less. When you look at that sizing, a lot of people talk about somewhere between 5 and 20%. But if you think about, hey, maybe I want 20%. 20% is a really meaningful allocation within an overall asset allocation. That's a big chunk. It's not the majority, but it has the ability to really impact returns, both positively and negatively. Being thoughtful, being diligent. And one thing we didn't talk about, I feel like this is revolving around whiskey, wine, art, but vintages. Just as we like wine and there may be a particular year that has great grapes. The winemakers love it. The wine is beautiful and it's fantastic. There are years where the grapes are terrible and the wine has very little value. Most people aren't interested in it. Investing, particularly in private equity and other types, you want to allocate a little bit of money each year into different vintages. One, to make sure you catch one of the good years. And then secondarily, you want to make sure you're not just doing one or two where maybe you hit it great out of the gate, but then you have the reinvestment risk where it comes back to you all about the same time, and you have to invest again and find investments at a period of time that might be terrible, or it might be great, and terrible is subjective. Terrible might mean the market's really overvalued, you have a lot of money coming back to you, and now you have to reinvest at really lofty premiums. I think that's another important factor.
It's more complex when you make those decisions around alternatives, knowing that you might have to double down in some cases, right? Or ensure that it's not just an episodic investment, knowing that you might have missed it, right? I think that's what you're trying to get to, and that's really, I think through my situation, and I think you're right. I'm not going to go into my alternative investment strategy because it would be embarrassing. But
let's spend a little time.
No, not public. Maybe next time.
All right.
I do think my last question for you is looking at someone like myself who might probably made some mistakes as it relates to that asset allocation mix. It's not too late, right?
Oh,
it's
God,
not
no.
too late.
No. It's never too late. We all look and think, oh, should I have saved more? Most people will say, yes, I could have, should have. Should I have allocated differently? Was I too conservative? Was I too aggressive? Yes. But you have this from this point for the rest of your life and the rest of your children's lives, that you can make a decision that will be impactful and meaningful for that. It's like dieting. When's the best time to have gone on a healthy diet and exercise? 20 years ago. But if you didn't do it, when's the next best time? Right now. Why? Because it's going to affect your health and your longevity for a long time. And your financial life is no different.
I love that. It's weird, though. We talk a lot about bourbon, whiskey, dieting. I'm concerned that we have like these concentric circles. This is a great segue, though, into the last segment, which is this thing we're calling Back to the Future. If you haven't noticed, we've been an 80s vibe here with the Gen X audience. And we're asking all of our guests, quite simply, if you can go back in time to your younger self, as it relates to your financial journey, what would you have told your younger self at one point in time? Not diet tips, but something around like a mistake you might have made where if I only did this differently.
Well, there's so many things that you can Monday morning quarterback and say coulda, shoulda, woulda. And there are a lot of individual cases like NVIDIA or Amazon or knowing the lottery numbers. But the ones that are in the realm of probability that you could change and that would be broadly applicable for me, and I think for a lot of people when they're younger, is to take more risk. Often as we talk with clients, they're older and we're talking about risk mitigation. Too often people don't take enough risk. Look at Tesla, look at Amazon, look at Apple, look at a lot of those. They've been expensive forever. If you're never willing to pay up a little bit for it, you're going to miss out on those securities, on those opportunities that can be a moonshot and really impact and change your life. And that comes into buying it and or selling too soon. I was a genius, for a little bit when I bought Palantir really early and made a boatload of money on it and sold it, patted myself on the back. Gosh, you're a great guy. He's really smart, only to watch it continue to march higher and higher and higher. Same story with a lot of securities. So take more risk.
Awesome. Love it. Don, thank you so much for coming on and talking alternatives. If you like what Don had to say, you can follow him on LinkedIn, of course, and you can find him on our website as well. And for those who enjoyed this episode, thank you so much for joining Dime After Dime. Make sure you like the episode, subscribe to the channel, and make sure to share it with a friend or family member, because the important part here is trying to help people make their ways through life financially. And this show is designed to do just that. Thanks again for joining us.